My guest today is Blair Silverberg, CEO of Capital Technologies, a software-based lending platform focusing on the venture debt space. In prior years, he's worked at the illustrious venture capital firm Draper Fisher Jurvetson and also invested personally in the private credit space. In his current role, leading Capital, he leads a team whose mission is to create a modern alternative to equity financing to put power back into the hands of the entrepreneur. Founded in 2019, Capital helps company founders understand their cost of capital and secure financing offers from 5 to 50 million. Blair, welcome to the Circle of Competence podcast.
Happy to be here. Thanks so much for having me. I'm happy to go on right after a friend like Neil O'Donnell too. So he's a tough act to follow.
Big shoes to fill. Well, speaking of Neil, so my fourth episode was with Neil O'Donnell, a lawyer who focuses on the venture debt space. Neil and I met through my blog, which is how Blair and I have now gotten connected. So that's how we've gotten Blair on the podcast. But Blair, why don't you give us like the 2-minute sketch of your life leading up to founding and now running Capital?
Sure. So I grew up in Austin, Texas. I had been an investor really since I got bar mitzvah money at the age of 13. And had always, I think by the time I was 14, I had read The Intelligent Investor, Security Analysis, Common Stocks on Uncommon Profits. I mean, all sorts of these books, pretty much every Buffett, shareholder letter going back to the Buffett partnerships in the 50s. And so I was just, for some reason, unnaturally attracted to investing at a very young age. And I went off to Stanford for college, moved out to the West Coast, quickly realized at Stanford there is no formal way to study investing as an undergrad. Stanford has a great history of investing, but that's all at the business school. And so I pivoted a little bit and I studied product design and was very fortunate to study under an individual named David Kelly, who founded a firm called IDEO, which is really the premier design firm for the Fortune 500 and has done a lot of work teaching big organizations and small how to invent and launch new products. And so for a guy who's interested in business, to understand capital allocation, but then also how you allocate your internal capital to new products and actually make them successful was this incredible synthesis of my interest. And so I went from Stanford to Draper Fisher Jurvetson, where I was there for just shy of 5 years. I worked very closely with an individual there named Steve Jurvetson. And I'll talk more about what I did there. But, essentially I had the consummate Silicon Valley venture investing experience. And it was fascinating. And there are, essentially everything that I do today at some level can be traced back to the synthesis of being a venture capitalist, knowing how to design products, and fusing these two very different views of the world.
Yeah, let's get into your DFJ years leading up to some of your private investing years and then Capital. Talk about some of the companies that you ended up investing in and sourcing, and what was the framework that DFJ uses to think about their venture investment.
Sure. So DFJ it was founded by John Fisher, Tim Draper, and then Steve Jurvetson in the really the modern firm was kind of in the early 90s. And they were the first investors in Hotmail, Baidu, Skype, just a number of iconic names. And this is really early stage R&D stage investing. And so the framework is totally different than you would expect for 99.999% of investments in the economy. There are no numbers to look at. You're really staring deep into the soul of an entrepreneur and you're trying to figure out, is this person going to create the thing that he or she is crafting as a vision before you? And that's a very unusual kind of investing. In fact, as we can get into, the vast majority of venture investing is not that type of investing now. In the mid 90s, when Steve Jurvetson started to now, the space has grown by 20 times in terms of capital deployed annually into the venture space. And so DFJ really was a pure kind of early stage investing experience. They, Steve in particular invested in SpaceX before they had a first rocket launch, in Tesla years before there was a car that, anyone could reasonably drive around in. And so, I can talk more in detail about how you do this kind of investing, but in short, you rely on the work by guys like Clay Christensen, Peter Thiel has written some amazing, like he has a book 0 to 1, but then also the notes on the class that predated that book that he gave at Stanford. It's really a lot about assessing competitive dynamics, whether a company can seize a small market and then use that initial traction to grow into a bigger market. And then ultimately, as a business grows, if it's going to be predictable, because many businesses, many trends, like think about the guy that I always tell this to people, that invented the toilet paper roll. It's like that guy captured no value from that incredibly widespread invention. And so to be a successful venture capitalist, you need to figure out how businesses will actually capture value from the inventions that they bring into the world.
Yeah, that's fascinating. I love Peter Thiel's 0 to 1, the notes on his lectures, but the actual book was a fundamental just shift in the way I thought about business. Talk a little bit about how that played into some of those investments, because to me, it sounds like a lot of those investments were true 0 to 1 investments, not 1 to N.
Yes.
And maybe give a little bit of background on that concept.
Yeah. So I think the first thing to think about there is that you're looking as a venture capitalist at a technology that if you step back and you think about, is this a fundamentally better, faster, cheaper, more efficient way of doing something that society is already doing? Is this, fundamentally better or not? And if you step back and you look at enough companies, and keep in mind, an active practitioner in venture will be meeting with anywhere from 500 to 1,500 companies per year as an individual. So you're just seeing a ton of potential investments. It's actually pretty easy to get the technical trends right. And guys like Steve Jurvetson write a lot about trends like Moore's law, even defined abstractly. So not just the processing power, is doubling every 2 years on a chip itself, but if you take that and extend it into computing clusters and human in the loop systems and the kinds of advances that have happened fairly recently in machine learning, the aggregate kind of high level computing infrastructure that you can rely on as a new business builder is rapidly improving in throughput and capability. And so when you step back and you see some of these trends, it's pretty easy to place bets on them and say all right, are there going to be real tailwinds for this kind of business or not? The hard part is actually choosing the right bets. So not a lot of people are totally transparent about this, but many people in the venture industry that I got to know while I was investing will say some things like, take social media. I didn't know which one was going to be the right company to back, so I just invested in all of them. That's actually the way to do it. In venture, you're buying options. You don't know which individual company is going to be successful. You do know that a trend is highly likely to be successful. You don't know if your timing is going to be right. And so the best you can do is place about 30 bets per fund, hope that anywhere between 1 and 2 are a massive success, which means they return the total value of the fund plus some. You then have this middle section of companies that the vast majority of companies in a good fund that either get your money back or a little bit more or a little bit less. And then you have some that just totally go to zero. And that is venture. If you really sum up how venture works, it's a portfolio-based approach to backing these fundamental trends where you don't know which individual company is going to be successful. And you just have to think about it that way, because that portfolio-based approach versus a deterministic, I'm going to put money into this company, 98% chance I'm going to get my money back. They're two totally different ways of investing. And you can't understand venture without understanding this portfolio-based approach.
So there's two things I want to dig in there. The first one was, it's easy to see the trends. It's hard to pick the winner. And so maybe talk about how, and it sounded like maybe you subscribe to the theory of picking the industry and maybe spreading bets within the industry, but are there trends that you've noticed that have come about studying the actual winners of the industries and the trends that you're looking at? Like, for example, DFJ invested in Tesla and SpaceX. It's obvious that Elon Musk is brilliant, hindsight 2020, but what did y'all see in the moment when this guy who has this huge vision comes in and pitches you, this idea of sending people to Mars or a massive electric vehicle company? I'm just curious from a human qualitative perspective.
Yeah, that's a great question. I can't take any credit for those two investments. Those were Steve Jurvetson's, and so he'd be the best guy to answer that question. But I can say, like, I invested in with Steve in a company called Nirvana Systems, which ended up getting sold to Intel fairly rapidly, became Intel's entire AI division. The founder ended up overseeing about 2,000 people, and that's a fascinating seat to sit atop Intel and think about all the ways in which artificial intelligence can be applied throughout the economy. And so, for example, in that company, they were attempting to build a new chip that was somewhat like the GPU, basically a new architecture that would parallelize the way that machine learning and specifically deep learning algorithms were working. And so in that business, you basically look at, is deep learning a thing? And it was pretty easy to see, yes, it is a thing. And it's shown already incredible results in areas like image recognition. And then you think, is there a new computing architecture needed? And it turns out in that case, you're basically doing a bunch of matrix math. And so to do matrix math efficiently, a CPU is quite bad at matrix math. A GPU is very good at matrix math, but there's some clear deficiencies in a GPU, like NVIDIA's main product is a GPU, for example. And so you answer those two questions, you're like, all right, this is a thing, and it will be investable. Now the question is this the right team to do it? And, am I in a position where I'm able to bet on this team without like risking the whole fund? You're no venture investors who put half of their fund into one opportunity. It's totally different than like the, Berkshire back up the truck. Let's buy, one stock because we know it's going to be successful. And so for that, is this the right team? It's actually quite binary today in the venture space. I'm not saying it's always going to be this way, but in the venture space today, there are teams that know how to build businesses and have done it before. And then there are teams where they're going to be figuring out a lot of these things from scratch. And so in general, most of the venture industry today biases towards teams at the very early stage where the teams have either done it before, which means they already have a list of people to recruit to join the company on day one. They've set up all of the internal systems of the company before. They know how to manage engineering teams from like 0 people to 50 people in their sleep. And so there's a whole level of operational risks that you're just not taking if you've backed a team who's done it before. And so there are times where a brand new team who's never done it before, like think Facebook, ends up getting funding because they figure out a way to learn all of the skills to build a business. Or for example, a friend of mine, Zach Parrott at Plaid, he was a first-time entrepreneur, built an incredibly successful company that they recently sold to Visa. Teams, every great team that's done it before did it for the first time, but the bar is a lot higher. And so like in the case of Nirvana, the team there was just exceptional. It was very easy and comfortable to back them and feel comfortable with them. And so oftentimes the team is like the final piece that decides which bet you make. But great teams all the time start businesses that are just a little bit before their time, think Webvan. And so you're just taking that risk fundamentally as a venture investor. You just do not know.
Yeah, that's there's a lot to unpack there. I mean, it sounds like having done it before is definitely a big box to check. Is there something on the business model side or in the opportunity set that just totally trumps a founder being like a first-time founder? Can you remember a time where you thought, well, they're a first-time founder, but this opportunity is too good to say no?
If you look at the metrics in a business, and you can see that when that business spends $1 on sales and marketing, let's say, they get $3 back in 4 months. That trumps everything because that's the dynamic that you would have seen with a Facebook, although you have to make some adjustments for businesses that don't monetize, at day one, which I can explain. But basically, when a business has metrics that are working, those are the first time teams that get funded, few questions asked. And in fact, that's actually great for the economy because one of the things that we'll talk about that the capital is doing is which I derive this belief through the venture industry of all places, which is, will seem unusual as we've sketched out how it works. But I have a belief that people are actually pretty bad at allocating capital to which opportunity is the right opportunity, but customers are very good at voting with their dollars and their time. And so if you can just clearly see through the metrics of a business, whether that business is gaining traction in a sustainable way, that is far and away the best barometer to decide where society's capital should be allocated to. And so there were a number of cases, like a company uh, called Periscope that we backed in the business intelligence space, where like the team was amazing, everything was amazing about the business, but they were first time founders. And the most amazing thing about the business was the cohort analysis. And if you just looked at the cohort analysis slide, you would have made the investment on that slide alone, because that was proof that they had created a business that customers were buying efficiently with minimal marketing and then buying more of as they, walk through time, basically upgrading their plans. And so anytime you see that, it doesn't, the society has this potential to create a system of financing companies that is quite unbiased. It's like you don't actually have to understand or think too hard about what that product is. There are people who love it, and it is therefore financeable. So yeah, I think the metrics can trump the background of the teams.
Right. Yeah. If the product is good enough, validated by the metrics, then the team maybe gets a little bit of a pass, I guess is what it sounds like.
Yeah, a little bit. Yeah.
This is really interesting to me so you started in venture, which is 30 investments throughout a fund, hoping that 3 to 5 of them are really going to hit big, and the rest of them will sort of either 2 to 3x or go to zero. And now you are the CEO and founder of a company that predominantly invests through a debt-like structure. And so I'm curious, like in the in-between, how did you get into the private credit space? What did that look like? Tell us how you got started there, and then how you transitioned to capital.
Sure. So there were a couple things going on. The first is when I was at DFJ, if you think back to like the mid 90s when a guy like Steve Jurvetson got started in venture investment as a category was 20 times smaller then than it is today. And so a lot more capital today goes into financing tech companies that are aspiring to grow to be large than ever before in human history. And by the way, about half of the growth in the venture industries come from China. And so this is now a global phenomenon. And if you look at where capital is actually spent, I describe DFJ being an R&D financier, a very risk-seeking investor. But the vast majority of venture capital today goes into sales and marketing expenses, low-risk feature development, and in some cases, like in e-commerce and in marketplaces, inventory costs. None of these categories are things that normal companies use equity to finance. And the cost of equity, on average, we service a bunch of companies now in our system, the capital machine, which I'll talk to, but the average cost of equity for companies in our system is about 54% per year. And so capital structures, as spaces grow, modernize. And so, for example, if you think about like Mike Milken in the junk bond days, there was a time where he was riding the bus to work, doing some math on his notebook saying, gosh, there's a bunch of companies here that could be financed with debt. The tech space will see that moment come, I think, in the not too distant future. And so I saw that. I just saw that there was a totally different capital structure in this gigantic space of tech opportunities than relevant for the rest of the economy. I also saw that that businesses that were able to take advantage of non-dilutive capital or just being smart about their capital structure earlier in their life ended up with founders who were anywhere between 2 and 9 times wealthier when they ultimately exited their business. And so being smart about this fairly early, many can argue like it is the most important question. It's pretty close up there to, did you build the right product and do customers love it? And so this is a life or death issue for companies. And then finally, I saw that unless you had one of a handful of just exceptional venture capitalists on your board helping you think through these issues, as a growing business that's raising less than $100 million of capital, you are totally uncovered by the investment banks. So Goldman will not cover you. You're too small. Why? Because human analysts doing models in Excel, can't bear the kind of cost and profit margin necessary to make that model work. And so today you're literally all by yourself running your own financing product or process as if you were, traveling the bazaar in Istanbul looking for products without some sort of merchandiser like Amazon to bring them to you. That is the state of raising private capital in 2020. And so I saw all of these things and thought that I could bring non-dilutive capital, and as we'll talk about, some real intelligence and context around whether that was a good fit for you based off of the stage in your company, to tech companies, and that could have a tremendous impact on the way in which these companies were built, reduce the pressure to build a company that's either a 0 or a 10,000x, and there's actually a gigantic middle of companies where technology provides real value to society, but the pressure to build a venture-backed, go big or go home business just doesn't make any sense. So all of these ideas sum together to lead me to where I am at Capital today.
Yeah, I think there's a real opportunity that's missing for those companies that are building very good businesses, but to your point, may not be a good fit for hyper growth, $100 million rounds from SoftBank, right? But before we get into capital, I'm curious, how did you get into the private credit space just as an individual? What did that look like?
Sure. So going from early stage venture finance to private, structured credit was a very contrarian move. And so I had to do it kind of the only way I could. I basically banded together with a bunch of family offices, some of which I'd gotten to know at DFJ, many of which I met afterward, essentially like-minded individuals. And we basically started with an investment club. And so I have a friend, for example, James Sagan. He's a fascinating guy. He and his father were my very first investor. And we financed a business that was rolling up media properties online, buying them at very low EBITDA multiples, and trying to operationalize managing portfolios of these online media businesses. And so it was stuff like that where there was a tech angle to the risk profile, and understanding how a venture-backed business might think about the space was essential to doing the analysis. But the right structure for that business, because it wasn't going to be a 10,000x, was not venture capital. And if you could structure the way you provide capital to it, you could actually, make both sides quite happy about the structure. And so I started just with my own money, and then these friendly family offices financing businesses like this. I got comfortable over a period of about 2.5 years with my ability to do non-equity financing, because it was very different than what I had done before. And what I found is that when you finance businesses in, like I said, pretty much every other facet of the economy besides early stage venture risk, you actually have many more tools to do the work for you. First of all, there are financial metrics, quite helpful to have those. Some of the things I talked about before about being able to quantify the degree of traction a business is getting is easier the later stage of business is. And so I was able to rely heavily on fairly traditional metrics to understand a business, and then complement some of the seeing around corners, understanding how a market might evolve with this venture thought process, and ultimately create a way of looking at companies, which we do now at Capital, that I describe to people. It's almost like a PE ratio. It's like a metric or a series of metrics. Let's say we have more than one ratio that, taken collectively, apply to all businesses. You can apply a PE ratio to a shipping fleet, just like you can a SaaS company or an e-commerce business. But, that shipping fleet in a cyclical contraction, the PE ratio is not the only thing you're going to look at. It might misguide you a little bit. And so you need to look at a few different indicators. But if you choose the indicators wisely, you can use the same indicators for all businesses. And that's really what we've built into the Capital machine, which is why today it's a system that allows us to apply credit toward essentially any kind of business and benchmark the risk profile of businesses to each other. And long story short, all of this emerged out of looking at individual private credit opportunities and working through them like one step at a time. And, ultimately deriving a financial theory that merged some of the best ideas in venture with some of the best ideas in credit.
Yeah, that's really cool, because it sounds like you had taken enough looks at these private credit opportunities that you started to see some trends of how to underwrite or automate the underwriting process. So before we get into that, I'm curious, like how are you structuring these deals with the family office as well as the company that was taking these credit arrangements?
Yeah, so the most common thing that we did is we'd provide a revolving line of credit to a business. And if you are a kind of tech-oriented growing business, there are some very important parts about the structure. And we do different things now at Capital, but I think this is an important kind of anecdote and answer to your question. So um, we would give businesses, let's say $10 million, and they could draw down at, say, $500,000 at a time for 20 months to get up to their $10 million. And so the business has a choice every time it draws money down, let's say like once per month, to look at the way that capital is being deployed within the business and make sure that that deployment is efficient before levering themselves up and taking on too much debt. And so this gives founders and business builders the ability to intelligently use leverage one step at a time. It's not like you're just taking on a bunch of debt over you. You have this overhang and oops, if I can't deploy money, 19 months from now efficiently, I've got to pay this big slug back. You actually get to one step at a time, lever your business, stop levering at a point where it doesn't make sense anymore, or keep levering if you find that your unit economics are staying stable or growing at the point that, by the way, you're getting operating leverage because your top line is growing from productive investment. So we identified this structure very early on as a structure that solved the needs of company builders that were dipping into credit for the first time, and solved our needs and mitigating risks, because you could actually every month have a conversation about, should we keep putting debt in together? And it turns out both sides are like partners and business builders together when they're having that kind of conversation. And then, so that was the predominant structure that I used when I first started investing in credit after DFJ. And then a lot of those ideas actually have led to how we work with companies at Capital, where the Capital machine, I'll explain, how we get the data in, but basically once we analyze a company in the Capital machine, the company and our investment team looks at the exact same charts and analysis and analytics to have a ground truth on what's going on with the business. So as a company draws capital, and let's say from us, for one of our balance sheet vehicles, same exact dynamic, except as I described before, except for it's automated. So, a company is looking at a bunch of charts saying, all right, am I deploying my capital efficiently? Are my unit economics getting better or worse or the same as historical periods? What actually makes sense here? And our investment team is doing the same thing. We're looking at exactly the same charts. And so if we see in 1 month, let's say that your return on sales and marketing went from, you got 30 cents on the dollar back in that first month to 5 cents on the dollar, we call companies and companies call us and we say, what's going on here? And we put our heads together and we brainstorm and we figure out, okay, there was a change in the Google search algorithm. Let's take a step back and let's figure out how to refactor our marketing campaigns to be more efficient and take better advantage of Google. There's probably some opportunity here. We just have to change the way we've been doing business. Or, hey, we launched a new product and it's not working out yet. Let's do some more R&D related sales and marketing spend, which, by the way, is best financed with equity. Get to the point where it's a real machine and then start using leverage to finance that spend. This is a kind of dynamic that should happen between investors and companies in all businesses. No reason for information asymmetry. It's just that when your investors are able to build Excel models all day long because they're investors, and you're building your product and business and customer service all day long because you're a business builder, those two sides aren't necessarily always on the same page. But I discovered being on the same page was just super important, even from like day one of, my private credit investing.
Yeah. That's going to lead us to the capital machine eventually. But before we get there, what do the family offices want out of sort of diversifying into private credit? Besides, I know that family offices will invest in real estate and private equity sometimes, a lot of public equities. They like to sort of maintain a diversified book of business. But what was the pitch to the family office?
In the early days, it was pretty straightforward. It was like, hey, treasuries are, 2 or 3%. Corporate credit is like, 4 to 5. High yield credit is like 6 to 7. And the duration on all these things is like 5 to 6 years. And you can make loans to private companies with a 6-month duration and earn a 14% net return. Like,
sign me up.
Yeah. So that was pretty straightforward. And that's still true in quite a few areas of private lending, particularly in the tech space where debt is so underutilized. And so what you really have to get comfortable with there is this distinction between, like, people will say cash flow lending and real assets. And there, it's really just a matter of investor preference. And so, the negative of financing a business where your package of security is a bunch of cash flows is you can't look back over 50 years of sales history for that particular address and understand what people have been paying for it, like it's a piece of, residential real estate that trades every so often. That's the negative. The positive is, as probably all of your listeners know, if you're investing in the most well understood assets in the economy, those are incredibly, incredibly competitive assets. And in fact, you have many people buying those assets who have incentives that are different from yours, like, hey, they need to hold a bunch of these so that they can mature and pay off, claims volumes that are estimated from insurance float. Like, if you're a family office investor, you should not be competing against insurance companies to price assets. And so it just so happens that there's a lot of work to be done in this cash flow based lending category. And, if you look at how business credit works, even though there's no quote unquote hard asset to serve as collateral, it's not like your loan goes to zero. It's not like cash flows disappear. These consumer trends, even business to business trends, customer behavior doesn't drop and change overnight, even during COVID, fascinating enough. So in the capital machine, we've seen what it looks like when COVID materializes in the economy. And it turns out that many of these behavior changes take a few months to materialize, and you see them coming. You can adapt your business if you're looking at the right data. So long story short, I think it's important to realize that it's worth it to do the work to get comfortable with asset classes that might on the surface seem a little bit riskier than long tenured asset class, because they're always less competitive and there's always more margin of safety there.
Yeah, where there's complexity and a little bit less competition, to your point, there's probably some work to be done. So let's get into the vision behind capital and what you've done so far, and then just to frame the discussion, and then we'll get into a few questions about capital technologies.
Sure. So I've always admired tremendously businesses like Goldman Sachs and Blackstone. That if you take Blackstone, they've grown their business, their AUM, the influence and impact they have over businesses in their portfolio exponentially since 1987. And if you concurrently look back at the venture space and look at efforts to invest in fintech businesses, you see a lot of early success that resulted in disappointment. So whether it was Lending Club, which I think is worth something like $400 million today, that went public at $12 billion, or whether it's Cabbage that is rumored to be getting sold soon, the efforts to transform financial services that the venture industry has put forth so far haven't quite gotten us to where we want to go. And you could look back and say, hey, that's just because financial services is fundamentally different. It's impossible to build a rapidly growing exponential business with in a space that is as regulated and has to be as perfect as financial services. And like I said, Blackstone is a total counterexample to that. It is from a return profile, the consummate venture-backed business. If I could have been in Steve Schwartzman's seed round, I would have been the best venture capitalist on earth. Same with Vista Equity and Credit. And so there is a whole set of business models around asset management that have not been reinvented with technology. And if you were to reinvent them with technology, you could imagine that society could get much better at allocating capital efficiently. And if I drop my grandmother into a partner meeting at an asset manager today and asked her, do you think that society is as good as it can be at allocating the world's capital? Like, my grandmother would say no. There's a lot of bias in the system, and that doesn't mean there aren't great investors, but it means systematically we're not terribly good at looking at all of the data and making the most data-driven choices when we're investing in private companies. And it turns out that there's a really good reason for that. And so what we've learned by connecting now thousands of companies to our capital machine is the average business creates in our machine about 40 gigabytes of data as they go about building their business, running their business using cloud systems of record. So think accounting systems, payment processors, their online banking. These kinds of systems spin off gigabytes of data. And as most of your listeners probably know, if you try to load 40 gigabytes of data into Excel, the tool that private market investors use to allocate $5 trillion of assets in our economy, the Excel file doesn't open. And it's not like it doesn't open for just 40 gigabytes of data, right? Which is basically twice what most people have on their computer, twice the memory that most people have on their computer. but it doesn't even open for files that are much larger than 8 megabytes of data. So what this means is 100%, minus us, but 100% of the investors in the private economy today, allocating and pricing $5 trillion of assets, are ignoring 99.992% of all the data they could be looking at to understand a business. This just doesn't make any sense. And so we built the capital machine to basically do what I'm describing, connect into company systems of record, suck in data, normalize it, benchmark it, show it back to companies and say, hey, is this the business that you think you're building? Does this look right? If the companies say, yep, this squares with our understanding, and by the way, I've gotten quite a bit of value out of seeing these charts and analytics, particularly in the ways in which they're phrased in terms of how investors might see a business when they're looking at businesses and benchmarking businesses all day long. We then get to look at that same information. Our investment team makes decisions about allocating $5 to $50 million into businesses. Because we're able to see a tremendous amount of detail into these businesses, we often get comfortable extending credit to businesses that should absolutely be creditworthy, but up until now have a hard time telling their story and accessing credit. We then help businesses save, like I said, between 2 and 9 times the dilution that they otherwise would if they continue to raise equity. And everybody's happy. And it's through a system like this that I think we can ultimately get much better at understanding the logistics behind capital allocation and actually making the economy more efficient.
So it's data-driven capital allocation, particularly in a debt flavor. Talk about some of the trends of what you've learned, some of the things that you've learned, some of the trends you've seen after looking over thousands of businesses' financial data and making decisions on where and to who to allocate capital. I'm curious what trends you've seen. Are there industries that are particularly more prone to this type of model than others? Is it fairly widespread or evenly spread out? I'm really curious because that's fascinating that y'all have that much data on that many private companies.
Yeah, so first I would say that you need to distinguish between a company that's attempting to grow and a company that's not attempting to grow. If a company is attempting to grow, the most important thing to understand is how efficient is that growth engine. And so it just so happens that there are the reason the venture space has grown 20x, there are a lot of technical tailwinds. We talked about some of them in the beginning, of our time together today, that are secular tailwinds. And so, for example, if you take a food delivery business at a time where smartphones make it possible for anybody with some spare time to go deliver food to people, and you combine that with COVID, you get a tremendous acceleration in consumer behavior change that was already accelerating, but it accelerated tremendously. So we track a number of different industries, with the capital machine, basically, that we think are secular trends that existed anyway, some of which are accelerating due to COVID. Online education is a space that we think is fascinating. There are real, immediate needs, and there are companies also that are like 20 years old that have been doing online education. And so you sort of sum up the fact that it was possible to do a lot of this stuff 20 years ago and compare that to this urgent demand. We're 2 weeks away from school starting in many parts of the country, and people don't know if they're going to be online or not. And so there are just a bunch of spaces that are experiencing real growth right now. But bottom line is back to my original point. You first need to figure out if a company is trying to grow or not grow. If a company is trying to grow, it's all about understanding the efficiency of that sales and marketing engine. If a company is not trying to grow, it's all about understanding how sticky the existing company kind of customer base is and what's going to happen to it over time. And so we're just really good at understanding, the answer to that first question and then digging into the second 2 questions. And really trying to understand the inner workings of a business and how capital into the business converts into growth and cash flow stickiness.
That's interesting. Talk about the first category of people trying to grow. What's a no go versus a go decision when you're looking at the sales and marketing funnel?
Yeah, so there's a concept that is prominent in venture called the magic number. And basically what that is if I spend $1 on sales and marketing and I look at the cash flow that comes out of that on a 12-month basis. Like I spend $1 this month and I figure out, hey, over the next 12 months, what cash flow is that going to yield? You can do a return on invested capital metric. And this is denominated in basically more than 1 is acceptable, more than 1.5 is, really acceptable, more than 2 is great, less than 1 is bad. And what that basically is saying, it's a very crude way of saying, if I invest $1 in sales and marketing in this business, do I get more than $1 back or less than $1 back? I.e., do I create value or destroy value? And then because you bound this to a year in the traditional magic number metric, there's a time element too. So if I get more than $1 back 25 years from now, my IRR on that dollar might actually be pretty low. So this is a very crude metric. It's thrown around a lot with SaaS companies. We essentially create this metric from transaction data by attributing every dollar that goes into efforts that should create growth, whether that's buying inventory, sales and marketing, originating loans if the underlying business is like a specialty finance company, buying equity if that business is rolling up companies. There's a number of places where money can go where you're expecting a return in a short period of time. And so we calculate if that spend is efficient, i.e. greater than 1 in this typical method. But because we have transaction data, we can actually calculate the shape over which it pays back. And this is a little wonky, but basically depending on the shape, like if you get let's say your magic number is over 1, you get 99 cents back the first month, and then you get 1 cent back the rest of the year. Well, you have 99 cents to reinvest all year round. So there's quite a bit of float effectively that you can compound versus if you get your dollar back, exactly on month 12. And so the shape of these cash flows matter a lot. And it just so happens that it's very hard to measure all of this stuff in Excel. So it's very hard to therefore see how efficient a business really is. And so then what ends up happening is many investors, particularly in the credit space, say, all right, what's the EBITDA? How many turns of leverage can I put on EBITDA? And many quarters, you can't put a turn of leverage on Amazon's EBITDA. So that obviously leaves a bunch of companies misunderstood, let alone all of the private, mini venture-backed ones.
Yeah, that's interesting. It sounds like to me the opportunity here is that private investors will typically look at this snapshots at, over every quarter or every half year, every year and see, okay, based on this snapshot, do I think how much leverage can this business support? Whereas you're getting instantaneous data by plugging into their financial systems, their financial backends, and you have the computational infrastructure already built to handle that. Maybe talk a little bit about what that looks like from a high level for those of us, including myself, who are not computer science majors or masters or PhDs. I can speak the language, certainly can't build it. So maybe talk a little bit about what that infrastructure looks like.
Sure.
and how you actually take in all that data and make use of it.
Yeah, it's a great question. So first, the core premise is if you're working with more data than a single computer can handle, you need more than one computer to work with that data. So we have a bunch of distributed computing, which is pretty common at companies like Google and Facebook. Totally uncommon at a place like Blackstone that literally has $0 of R&D budget, but it's pretty common in the tech world to have this kind of setup. So we have a distributed computing system rather, that basically allows us to hold all of the data we need to understand a single company in memory at one time to do analysis on it. The second, kind of concept here is how do you actually get the data in? So we have a team, we call it the data acquisition team, but this is a team of engineers that build systems to plug into systems of record like QuickBooks and NetSuite and Stripe and Square and all sorts of different systems that businesses are using to run themselves and efficiently pull the data in. And so, when businesses work with us, we initially take it in whatever form they like. They can upload an income statement. They can log into Stripe and give us permission to look at a read-only, private, non-PII kind of viewable view of their account. There's all sorts of different ways they can get the data in, but ultimately at the time that we actually allocate capital, we have direct system of record integrations. And so that's the second piece, the data acquisition piece. And then in between basically those two things is a bunch of what we call data engineering or data pipelining. And that's taking data that might be in QuickBooks' own language and converting that into a financial language we understand. Like, what actually is revenue by our definition of what we think counts as revenue? And so that's just a ton of rules, some machine learning, and even just some math, some kind of pure, it's kind of fascinating if you're in a vertical specific kind of data analytical space like we are, that you can just use math oftentimes to figure out the right answer. You don't need fancy machine learning for a whole host of things that you might in a more generalizable space. But all of these things string together to ultimately produce, like I was saying before, analytics that we and companies look at together to understand capital allocation and then to make a credit decision.
And I'm really curious because at scale with a lot of this data, it sounds like you've potentially gotten to a point where it's just a machine learning classification problem of, are they trying to grow? Yes. Okay. How efficient is their sales and marketing? It's great. Okay, let's invest X number of dollars. Are they trying to grow? No. How sticky is their customer base? Very. Okay, let's invest. So talk about how automated or maybe not so automated the capital machine is, and what's the vision there? Is it ultimately going to be purely automated? I'm curious sort of how those decisions get made based on that data.
That's a great question. So you absolutely nailed how the investment algorithm works. That's exactly, and that's how, a smart human investor's algorithm in their head works. So we totally have just replicated, a model that great humans have been using to make decisions for a long time. In terms of how this gets more automated, is it fully automated today, so on and so forth. We're of the view that it's pretty straightforward to automate that credit decision, even, to allocate $50 million or more to businesses. But when you take on that large of a capital commitment into your business, you want to have ultimately a conversation with an investor and discuss and brainstorm, where are you going to use the money? Is it going to be efficient? How should you structure it? What other advantages should you have? Are there companies you should acquire? So we have a team of investors, veterans from places like Oaktree, that have those conversations with companies. It's just that we have those conversations after we know the company's business quite well, and we don't ask for pitch decks or any data prep for us whatsoever to get to a stage where we can have a very rational conversation. But I think, personally, that this could technically be fully automated. It's just really up to the preferences of businesses. And then in terms of where we spend a lot of our technical effort, one place, honestly, is just communicating our model, which is very generalizable, in a vertical specific format that company operators understand. So it's fine for people inside of capital to basically throw around a bunch of functions with shapes. That's probably how people talk at RenTech, too. But to the outside world, for someone to really understand what's going on, you're thinking about what your business actually does, right? So I have widgets. I have a certain price per widget to make it. I sell it for hopefully some multiple above that price. And then I've got a bunch of OpEx. And when you take all that stuff out, I either profit or I don't. And so we're able to basically map our view of businesses into these vertical specific views in a way that stimulates really easy back and forth conversations, but doesn't impose on us the requirement that we model every line of business differently. Like I said about PE ratios, we model every line of business the same. We just translate our view to these verticals, but that's actually a huge part of where the effort goes. And it's really just, it's additive to the experience because it is important that you talk about a business in the language of the people who are building the business. And, when we work with, whether it's our balance sheet or, partners that we co-invest with, it's important to talk in the language of investors investing in a business. So that it's a lot of, human dynamic at the end of the day.
Yeah, that's fascinating. I was literally just thinking, so they're building RenTech, but for the credit space. But it sounds like, again, to stroke a check for $50 million, you do want a human set of eyes to look over the credit agreement and understand where that money's actually going to. Do you think that at some point, though, that it literally will be a fully AI-driven system where a company will be able to plug into the capital technology platform and basically there's so much data and such a good, deep learning model or whatever type of machine learning you're using that it gets that efficient?
Basically, I would answer that question with a yes. There's a very important thing to mention here. So, uh, if you look at what quant funds have done in the public markets, I mean, they've obviously transformed the fee structure, the efficiency of the markets in many cases, and are clearly the wave of the future. I mean, you can just list the number of hedge funds that have shut down since 2012, basically, and directly see how quant funds are the beneficiaries. And so, undoubtedly, many of those concepts will apply in the private market. Now, there are some differences that make the answer to your question yes, that really would be no in the private in the public markets. So in the public markets, you're trying to estimate how the price of a security might move. And to do that well, security prices in the long term, of course, are proxies for economic fundamentals. But in the short term, they like Mr. Market is now just a bunch of computers. They can move around quite a bit. So you're having to guess at how counterparties buying and selling securities are valuing a security at any given point in time, i.e. you're having to read other people's minds. That's a very difficult problem to fully automate away. In the private markets, all we have to do is understand how customers interact with their vendors or service providers. And so a customer generally isn't deciding to pay more or less for a product because some other customer might pay more or less. There's not this short-term adaptive, adversarial dynamic that ultimately yields pricing and cash flows for the businesses we finance. So in general, what you're doing is you're truly just modeling economic trends and fundamentals. And yes, if the Fed starts to pull liquidity out of the system, people start losing their jobs, prices for certain goods might go down. The opposite can happen. But as those of your listeners who were paying attention to the mortgage market in 2006 know, it can be like 3 years of a trend unfolding, and you actually see it happening in the fundamentals, even though in the liquid markets, like overnight, people get an idea and prices adjust immediately. And so it's for this reason, the slow diffusion of information into the fundamental economy, that you can automate many of the investment decisions into private companies. Like I said before, that doesn't mean you should or we should right now, but it does mean that we can as a society, and therefore yield the cost savings that have materialized in the public markets.
Yeah, that's a great point, that there is a large difference between when the public markets perceive something and when the private markets when it actually occurs in the private market. So if you actually go look at the real estate crisis, 2007, then it crashes in 08, 09, we're sort of back on the uptrend. Actually, a lot of commercial markets didn't bottom till like 2011, because they had so much so huge of a volume of foreclosures to work through. And to your point, the private markets just move a lot slower, so you get to see the fundamental trends sort of transform, even as the public markets have already sort of either priced it in and then sort of error corrected for that. So I think that's a great point. You mentioned you all have co-investors and partners. You mentioned Oaktree. Howard Marks, one of my favorite investors. Talk about maybe how that works with co-investors and how y'all structure these credit deals with companies that qualify in your platform.
Sure. So oftentimes, large family offices, banks, other institutions reach out to us and they say one of two things: either, hey, I have a growing, let's say, venture debt practice internally and I want to make it more efficient, or I have money that I want to put to work, and I generally like the space that you guys are in, and find having capacity to grow my exposure to that space attractive. And so that basically creates two dynamics. We manage money on behalf of balance sheet partners. You can think of them basically as separately managed accounts. Typical account size is $50 million or larger. And those are fully managed relationships, and we have people from places like Oaktree and KKR that are the investors that ultimately sit behind and service those portfolios of company investments as well as investor relations. And then the other route is much more of a lightweight co-investment. Let's look at deals together and both share in the work relationship. And the way that ends up working is companies and institutions basically meet on the capital platform in a very closed, managed way. So it's much more of a club at this point than it is like you can go into a
A
marketplace and you
marketplace.
don't meet anybody. Yeah.
Right.
But everybody is doing their kind of interaction and discussion over the capital machine, and that just creates a lot of efficiency because it standardizes data. And so that's a way that we can get to know balance sheet partners and decide if it makes sense for us to escalate a relationship to a real balance sheet partnership by looking at deals together, working together in the capital machine, assisting with the co-investment, helping them think about how to refine their credit box, us understand their credit box. So this is basically an escalation path in our business that's essential because also as your listeners can appreciate, the sources of your capital in many cases can define your advantage and certainly your longevity. And so we take groups that we do formal partnerships with very, very seriously, and we make sure that our goals for our business are perfectly aligned with their goals for their business over a very long time frame. And so that doesn't always mean that we're going to find a balance sheet partnership in a firm that could be an amazing fit for one of the companies in the capital machine. And so this other path, which is just much more of a co-investment, let's make matches with people path, allows us to bring the fact that we have an incredibly broad purview and visibility into partners, the terms they like to finance deals on, to all of the companies in our system. And so we routinely, at this point, will just take terms from companies like, hey, I have a term sheet from this bank at X. Do you think it's beatable? And we're like, yes, in fact, it is. And let me walk you over to some other bank and beat it by 25%. And so that's sort of the benefit of sitting as a platform in between companies and investors that are working together. You can really add a lot of value to both sides.
Got it. So you are more so facilitating these credit agreements versus investing at for example, one of the like a higher rate of interest based, similar to your earlier private credit investments. Is that more along the lines of what you guys are doing?
Yeah, I mean, we do both. So we call it principal investments is our arm that makes direct investments in companies using these separately managed accounts or balance sheet vehicles that we manage closely on behalf of partners. And then there's essentially a co-investment kind of arm that stems off of that, that does this club-like investing that I mentioned before. But the most important thing to mention about us, I think, is we are, like I mentioned before, some of the businesses that we admire, we aspire to give efficient access to capital to companies and efficient access to investment opportunities to investors on both sides. And so that inherently is not let's go find, the most crazy opportunity for alpha, which is going to be $20 million in capacity kind of business. There are people who use the capital machine to do that. They're quite successful. And we, as early adopters of any platform are, using it wisely, we love those kinds of investors, but we're just a facilitator as the platform. And so if you have some alpha strategy that's $10 million and you think you can make it $30 million and this is in the private market, we would love to talk to you because we can help you grow. But by and large, from a balance sheet partner perspective, these are institutions that are looking to put money into space in a scalable fashion with clear reporting as to where and how the capital is being used. And in turn, they provide very efficient cost to capital to companies that, as I mentioned, often don't qualify for debt traditionally. And, there is certainly some alpha there just by extending leverage to tech companies because you're competing, against a 54% average cost of equity. But in general, that's how we bifurcate the world. We just think of ourselves as a platform and a facilitator.
Makes sense. That makes sense. Before we move on to the final round of questions, you're hooked into all these private companies and their financial data and their back end. Besides some of the more obvious trends that have been accelerated based on, because of COVID, have there been any interesting, maybe counterintuitive trends that you've seen from some of the businesses that you guys collect data on?
Yeah. I mean, so the caveat here is like, if it's super, super interesting and proprietary, like I'm never going to share it publicly, but there are some that are just to protect the businesses that are connected to our system, and their own source of advantage. But there are some very interesting ones that I don't think are excessively, they're counterintuitive, but they're not excessively proprietary. So for example, in May, let's say April and May, companies doing commercial construction actually saw the revenue go up quite a bit. Why? Makes total sense in hindsight. Never would have guessed that like a construction company in the depths of COVID would see the revenue increase, but makes total sense in hindsight because in hindsight, a bunch of commercial spaces shut down and it was easy to do planned construction on them. And so that's one example. Many other ones at this point are more intuitive, but the pace at which they were unfolding was less intuitive. So there are a number of businesses that saw like their customer acquisition costs get cut in half, like within 14 days of these stay-at-home orders. And so that means people pulling out of, marketplaces like the AdWords marketplace at a very rapid clip, leading to lower demand and therefore lower prices. So sometimes it's just the timing that seems counterintuitive. It's like I would have thought, some of these AdWords markets had, basically standing contracts that had much more lead time to get out of, and that didn't appear to be the case. But yeah, we see a whole host of interesting things. And, for us, we, much like a business like Standard and Poor's, where you can create indices from data, we're always trying to provide a level of visibility and granularity to businesses that connect to us that is useful and additive to their own capital allocation without giving too much specifics and, betraying anyone's trust. And in fact, the way the data works in our system is it's kind of incredibly protected and double opt-in. And so, for example, just like, if you're sharing a file with somebody on Google Drive, for a company's data to get in the hands of an investor, that company has to authenticate the investor. That investor has to want to see the data for the company. And so when we act in this facilitator role, I literally give people the analogy. It's in a way, it's like we've just built a fancy data room. Just works like every other data room. It's just a little bit more fancy.
That's very cool. I think to your point too, being in the middle, in the facilitator's seat, gives you a lot of power in a lot of ways, but also a lot of responsibility to handle that data responsibly and protect it, and use it as the company wants you to use it. So especially given, all of the hubbub around security breaches and risks around that. So I imagine you guys take that very seriously. Well, let's wrap up here. I've got a few set questions that I ask every guest, so we'll roll through those and then wrap up. What personal values or beliefs are most important to you, and how do they inform your day-to-day business?
What personal values or beliefs? Oh man, there's a lot of these. I think that probably the most important one is to just think things through from first principles. There are a lot of times where it's easy to solve a problem by analogy. The thing that we've created, I think, a great culture that does this on the team at this point. But the thing, if I can bring any value to the people on my team, to the balance sheet partners we work with, to the companies we work with, is really just look at data and think things through from the perspective that data is telling you. And so, from that simple truism, derives all sorts of wonderful things, reinventing and changing the way that companies interact with investors, reinventing and changing the ways that we manage, like engineering management, for example. I think we do things very differently, and people seem to have a lot of fun, working on the engineering team. Even in my personal life, my wife and I, we have two young kids, a 5-month-old daughter and a little more than 3-year-old little boy, working from home. It's like we just had to sit down and tackle that problem from first principles. Like, I need a certain number of hours to work. Family needs a certain amount of support. Let's make a schedule. So I'm just a very big first principles kind of guy.
Agreed. I like that. What advice would you give yourself starting out as an entrepreneur and an investor, knowing what you know now?
The entrepreneurial advice is pretty simple. There's a person on my team who's very close with a very, very famous entrepreneur, and talks about stories when this individual would say, like, I will literally just sell my car to make my company successful. Like, I would get rid of the shoe on my foot. Before you start a business as an entrepreneur, you have to be willing to do pretty much anything. as long as it doesn't violate your ethics and your morals. So my advice to entrepreneurs is just be ready. Assume that you're going to be living a lifestyle and you're going to be doing this for the rest of your life, and be happy with that before you start a company. And if you can get there mentally, you're indestructible. And if you can't, which many people can't, you shouldn't start a company, because you don't know what the outcome will be. And it is, in today's society, if the coronavirus has taught us anything, like, unpredictable things happen. And so if you can find gratification in the work you do every day building a business, you will have fun no matter what happens. And if you're working toward an outcome, it's very, very difficult to control what that outcome is. So that's my advice to entrepreneurs. My advice to investors is not dissimilar. Like, build a portfolio, because you don't know what's going to happen in any single position, and try to have the best data access you can so you can track what's going on in real time and adapt to it.
That's great. That's great. Staring into the abyss and chewing on glass, as one famous entrepreneur said.
Absolutely. There's a great documentary when he did that in 08 on Netflix that everybody should watch.
What is one thing you would have done differently now that you're a decade or so, almost a decade into your journey as an entrepreneur and investor?
I would have worried a lot less when I was younger. I have tons of anxiety in my family. Have gone to a therapist for many parts of my life. Like, it's common with many European Jews and their descendants, a lot of anxiety in the family. I just wouldn't have worried about things so much. I think things end up working out if you're patient. And if you can get comfortable with patience, that alone can be anxiety reducing. Now, if it's possible to, know this when you're young, like, could I have known this when I was 22? Probably not, even though I heard it. But that would be my advice. Absolutely.
Worry less. I love that. What person would you most like to meet who is alive today, and what would you want to talk about?
Ooh, definitely Ray Dalio. I've never met Ray Dalio. The way Ray Dalio has codified his mind in the form of rules and processes, to me, is just fascinating. And so, I have great respect for people who basically create order and process out of the intuitions that they've accumulated throughout their careers. And I just think he's exceptional at that.
I could not agree more. And I've read every single word that he has written. The Principles of Debt Crises, the way the economic machine works. His recent series are great for anybody who hasn't read them. The Changing World Order. I mean, the guy is, I think we will look back in 200 years and say that he was one of the greatest economic and investment thinkers of our time. I could not agree more.
Absolutely. No, he's an impressive guy, and it's wonderful for society that he's making his ideas visible and transparent for people to learn from.
That's probably the best part about it, is that he is genuinely trying to put this information out there for people to debate and take it or leave it if they don't agree. And so I agree with you. I do appreciate that as well. All right, so let's just say you can't invest in or operate in the private credit space anymore. What industry or asset class do you pivot to, and why?
Oh, if I can't invest or operate in the private credit space, I would just go back to investing in early stage venture. There's infinite alpha there if you're comfortable with the risks, and it takes a long time to build. I mean, depending on your temperament, but for me, it took a long time to build the comfort with failure to make early stage investments. So I would just go back investing there. It's a ton of fun.
Easy answer. What's the biggest challenge in your life personally and professionally, and how are you attempting to tackle it?
The biggest challenge in my life personally and professionally is building a business with major offices, one in Mexico City, one in New York, from home during COVID with a 5-month-old daughter. And as I mentioned, a little more than 3-year-old son, and just teaches you a lot about structure and organization, and really thinking through how to build a system around dealing with the current reality. So it's nothing more than the first principle stuff I said before. It's really just thinking everything through, everything that feels like friction, think it through and address it head on. And there's a great podcast with Matt Mullenweg and Sam Harris talking about how Automatic built its culture to work in a distributed fashion, that a number of different CEOs we work with all sent me the same podcast. And that's how I know that it's a great one. And it really is. And the level of deliberateness that they've taken to building their organization, it's obviously served them incredibly well, now, but you just have to think about all of the details and get them right, and then go on to the next detail and get it right. And what I'll sometimes tell my team is that when you build a startup from scratch, you start, and on day one, by default, everything is broken. Nothing works. When you're done, or at least 25 or 30 years in, like Jeff Bezos is, you've created order out of so many things that were once broken. And you can look back at that structure and process that you've built and really face, or feel a lot of gratification and joy. And so, it's just doing that over and over again is one of the things that I find most fun about this.
Yeah, we are certainly living in an interesting time with new constraints. That is for sure. So how can someone listening to this podcast add value to your business at Capital?
Yeah, I'd say that if you are looking at some market, you think you understand it really well, ideally in the private market, and you think that you found some great source of investment opportunity, but you need help scaling up and building a kind of bigger, more scalable access to some market, we would love to talk to you. I mean, guys, on my team spend a lot of time thinking about what investment opportunities there are, leveraging the visibility we have from the capital machine. And really the biggest constraint to making great investments is great investors thinking about how the world is changing and where to provide, capital and liquidity to companies that are struggling to get it. And so I think that's probably the clearest one, particularly for your audience. We just love hearing from smart investors, and we try to bring our tools to bear to make them better and more efficient, whether that's just co-investing together or some sort of a formal partnership. But we love putting our heads together with smart people.
10-4, all the investors out there, give Blair a shout. Blair, thanks so much, man. This has been really fun, really educational, and it sounds like you're building a fantastic platform, and best of luck to you. Thanks for coming on.
Absolutely. Thanks so much for the time.
This is Benton here again. Thanks so much for listening to the Circle of Competence podcast. To find more episodes like this one, go to circleofcompetence.co. That's circleofcompetence.co to sign up for my weekly podcast emails, as well as a monthly summary of links to blog posts and articles I liked most from the previous month. Finally, if you enjoyed the show, please leave us a rating on iTunes, which will help more people discover the work we are doing to explore the entrepreneurial investor's journey. Thanks again for listening.